Okay, so we were talking about this is the Mike Green topic, Grant, talking about how much money is being mindlessly invested. And I was touching on the flow issue because there's a tendency just to focus on, this visual here, which is about 50% of money is managed, or really, I already said that it's not managed at all, it's just indexed. And what's your take on his flow analysis?
On Mike's,
Yeah, how much does he say something like 80% of all flows that go into the
it's up
market
there. Yeah,
go
it's north of
passive?
70. It's north
Yeah,
of
it's a
70%.
huge percentage,
Yeah,
and
yeah.
that doesn't get much attention. So that's a very important point. And the idea is that markets are supposed to be price discovery mechanisms, and they're not. I mean, this is just a major problem. We had that with the Treasury market when the Fed and the other central banks were buying all those government bonds, which obviously greatly distorted the bond market. But now we're getting a complete lack of, or maybe complete lack is too strong, but a decided tendency not to have true price discovery. And it is really just kind of this massive momentum chasing game that's going on right now. And, when you look at how are the asset managers, and this is apparently both active and passive, I mean, they're really, really long this market, as my good friend Jesse Felder points out. So that's, if we look back at the past, those episodes where it was at least in the same kind of vicinity did not end well for long investors. And I think it is fortunate that not everybody's drinking the Kool-Aid. We've got, again, thanks to Jesse Felder, a visual here from the famous John Hussman, who at one time was considered to be brilliant. He stayed bearish too long, but his data is his data. I mean, it's hard to argue with. And this is another one that I think is really interesting. And this gets very little attention. I don't even know if Grant has seen this, at least recently. Ned Davis used to run this periodically. This is from my friend Jim Colquitt. And the idea is that when you look at times when investors have a very high equity allocation overall, the future returns over the next 10 years are very poor. So when we see that blue peak there to the center right, that was the late 90s, the infamous tech bubble. And then you fast forward to 10 years out, and the yellow line showed very low returns. So, and the reason that line stops is because you have to go 10 more years out. But what it tells us is with the peak that we've got now on the far right, the odds are that when we look 10 years from now, the returns are going to be very, very disappointing.